Jerome Powell just sent a warning to all investors. The U.S. economy is heading for a period of higher prices and slower growth. World financial markets are reeling under the pressure of new U.S. tariffs and growing economic uncertainty. The Fed is warning of inflation of up to 4%, GDP growth slowing below 1%, and unemployment rising to 5%. This situation may be reminiscent of the 2008 period of uncertainty, but it is even worse. This time, the Fed is not holding all the cards, and any intervention by it in the economy may not have such an effect. A recession is on the horizon, and stock markets are adjusting accordingly. The S&P 500 is down 8% since the beginning of the year and was teetering on the edge of a bear market as recently as last week. But the Fed's warnings foresee an even bigger drop. How far can stocks go? The Federal Reserve is still raising expectations for consumer inflation, which has reached levels not seen since the early 1980s. Coupled with jittery markets and rising U.S. Treasury bond yields, the Fed is not ruling out either scenario in determining whether the economy is facing a new price shock from tariffs or is headed for a downturn. As households, businesses, and investors quickly adjust to the consequences of President Donald Trump's aggressive import tariff policies, Fed policymakers have said the outlook is becoming increasingly difficult to predict. Indeed, they assessed recent market movements and a worrisome rise in consumer sentiment about looming inflation, and are pricing in an economic downturn. New York Fed President John Williams, in a speech that included estimates that growth will fall below 1% this year, inflation will accelerate again to 4%, and the unemployment rate will rise to 5%. Bad results for a central bank that wants to keep inflation low and employment high, said this year will continue to be very tight. In the worst-case scenario, which is the closest we are currently getting, a sharp rise in the near-term inflation outlook will start to put pressure on the Fed's monetary policy, which is still expected to ease gradually this year. The Federal Reserve is an independent organization, but is currently under pressure from the U.S. president to cut rates as soon as possible. But why does Trump actually want this? The whole purpose of the current tariff war, apart from the fact that Trump wants to bring manufacturing back to the U.S., is also to weaken the dollar and thus reduce the national debt, which is really enormous in the United States. Moreover, thanks to the tariffs, the government is making billions every day, which helps it to deal with this debt. Fed policymakers are emphasizing keeping long-term inflation expectations at bay, but at the same time they are watching the steady rise in expectations for the year ahead, which climbed to 6.7% on Friday as a result of Trump's tariffs, according to new data from the University of Michigan. What also keeps climbing higher is the number of subscribers to our channel, so toast too. And don't miss Wednesday's video, which will focus on a growth market that is easily outperforming its European and U.S. counterparts, and may now present interesting opportunities. A sharp rise in inflation expectations would threaten the progress the Fed has made in controlling pandemic price growth. Indeed, over the past few years it has managed to bring high inflation down to much lower levels, which, it is important to mention for now, are still close to the 2% target. But it will not be hit anytime soon. It was the combination of high inflation and high unemployment that led former Fed Chairman Paul Volcker in the late 1970s and early 1980s to prioritize controlling inflation with punishing interest rates that triggered the recession. Indeed, the rates so-called are those that the Fed will raise to really high levels, as high as 20% as in the 1980s, in order to slow down inflation, which at that time was in double digits, at any cost. But at the other end, this intervention plunged the economy into recession. But this situation can be exploited by investors on Bulios, who, thanks to their Bulios Black membership, have access to absolutely unrivaled features such as the Fair Price Index, Flash News, and Portfolio Tracker, which save them a lot of time they would otherwise have to spend on analyzing individual companies. So check it out and pick stocks like a pro. Since Trump's announcement of the tariffs, U.S. stock and Treasury bond prices have fallen simultaneously, a potentially worrying signal that investors are turning away from U.S. assets more broadly. Last week's suspension of some tariffs has so far failed to offset this shock. And it is with bonds that we will stop for a moment, because the bond market has sent a direct warning to Donald Trump. A sharp sell-off in government bonds, unusual at a time when there are fears of a recession and stocks are plunging, has prompted the president to suspend the toughest reciprocal tariffs for 90 days. Yields, which move in the opposite direction to prices, have shot up this month as the trade war escalates. 30-year U.S. Treasury yields hovering around 4.5% and 4.9% on Friday, respectively. Those are the highest yields since February, shortly after Trump took office, which sparked a bout of uncertainty in the bond market after he first unveiled his tariff plans. Why is this unusual? While markets have generally been volatile since Trump's return to the White House, such jumps in U.S. Treasury yields are not normal. It's a sign that investors no longer consider government debt a safe asset, which could spell trouble for the stability of financial markets and future financing of government operations. Government bonds typically rise when stocks sell off and investors price in recession risk. This means that yields would fall, as they did in 2020. Something like what is happening now simply should not happen in a market as large and liquid as U.S. Treasuries. It's not normal, coming from Wall Street. Why is this happening? Professionals say there are several reasons why the bond sell-off has accelerated. The most significant is foreign selling. Foreign investors have been shedding their holdings of U.S. Treasuries in recent months, likely because of reduced confidence in the U.S., or to gain access to U.S. dollars in case trade with the United States begins to taper off. Foreign investors sold bonds for the third straight month in January, with the net value of their holdings falling by $13.3 billion, according to data analyzed by SocGen. Investors dumped $24.1 billion worth of bonds in the month. China's holdings of U.S. debt also fell this month and have been declining since 2014. So while it may appear that the stock market situation has calmed down at the end of last week, investors still haven't won. The outlook for the rest of the year and for 2026 is not good, and the central bank is counting on the economy to decline. Bonds are also sending warning signals. Coming Wednesday, a new video will look at another growth market that is beating the US one and can help investors get through this challenging period. So be sure to subscribe so you don't miss it. Investors on 𝗕𝗂𝗶𝗀𝗀 continue to discuss the latest opportunities and happenings in the market. So join in or let's get the discussion going in the comments. Good luck with your investments.